Want to start on a theme I was just talking about with Julie there, and about the economic data we're getting, David, this week. So manufacturing and jolts. We just got the Fed's beige book, David. It showed the number of districts reporting flat or declining activity actually jumped from 5 to 9. It does feel, David, like growth concerns starting to bubble up again. I wonder if you share those concerns.
Exactly. It does feel a lot like the beginning of August, at this point in time. Now, overall, we do think the stock market here is pretty fully valued. In fact, it's actually a couple percent above a composite of our fair values. So not necessarily surprised to see a little bit of choppiness, a little bit of a pullback here, in the short term. And as you mentioned, I think the market right now is just trying to digest a slowing rate of economic growth. Now, in our view, it's not necessarily surprising. We've been in the soft landing camp for quite a while. We're actually looking for GDP in the first quarter, in this current quarter here, to slow down to 1.7%. We expect it to slow sequentially through the end of the year, getting all the way down to 1.2% in the fourth quarter, going to 1.1% in the first quarter, and then just slowly starting to reaccelerate thereafter. So from our point of view, when I look at the macroeconomics out there, I think the tailwinds right now are pretty much offsetting the headwinds. So that's why I would still consider, from a market point of view, to stay at a market weight depending on your portfolio allocations. From the tailwind point of view, we expect inflation to continue to keep moderating from here. We're looking for long-term interest rates to be really on a multi-year decline, and then, of course, for the Fed to start easing monetary policy. So really, the only headwind is that slowing rate of economic growth.
Could be a big headwind, though, David, I guess, depending on how much it's slowing, right? So I did see some commentary today that the Fed, even before Friday's jobs report, would have enough material, given some of the economic data we've already gotten, to cut rates by a 0.5 percentage point. If they do that, what do you see as the sort of equity market reaction?
I'd actually be very concerned if they cut by 50 basis points. If they cut by 50, I think that actually could send the wrong signal to the marketplace. Of course, the Fed has been just laser focused on inflation for, the past 2 years now. For them to come out with a 50 basis point cut is really going to tell the market that they're actually much more concerned about the potential for a recession in the near term than they are about inflation. In that case, I think instead of, the market actually viewing that positively, I think the market would look at that negatively, and we could actually see stocks sell off in that case.
And so, David, so you wouldn't be looking for a supersized 50. You'd be looking for more traditional 25. How do you think the market would respond to 25? And what's the pace of cuts you would expect after that?
I think at this point the market's fully baked in the 25 basis point cut, so I don't really think there's going to be a huge market reaction, to the Federal Reserve. We're looking at 25 basis point cuts, each of the meetings, thereafter. So we're looking at, by the end of next year, the Fed to get down to about 3 to 3.25% range by the end of 2025. And even just as importantly, we are looking for a multi-year period of long-term interest rates coming down. So for the 10-year, we're currently forecasting the 10-year to get to 3.5% by the end of this year, and then falling to 3% by the end of 2026. So I think that will help, propel the market, give the market, good tailwind, over the next, call it 15 months or so.
And David, to dig a little bit more into your strategy, which you alluded to earlier, there are two groups that you are underweight that I want to dig into. One is technology, and the other is utilities. And I mention them both in the same breath because they've sort of gone hand in hand very unusually this year. But you think it's time to pull back on those two groups?
Exactly. So with technology, I just think that too many of these AI stocks ran, too far, too fast here in the short term. They've definitely gotten to be overextended and in many cases, overvalued in our mind. So in that sector, I'd look to take profits out of there, look for some of the other names that have lagged behind. But the utility sector is actually, in my mind, even more interesting, from a negative point of view today. That sector, it was just crashing last fall when interest rates were going up. In fact, we noted that, the utility sector on a valuation basis was pretty much as undervalued according to our valuations as they had been, over the past decade. But that sector's up, about 22% year to date. Even more than that, off of those lows from last October. So at this point, I think it's time to move, to an underweight there. The big story this year has been that utilities really are kind of that, second derivative on AI. Of course, electricity demand will be increasing as more AI comes out there because AI takes, many times more, power to run than traditional computing. But I'm just thinking right now, if you're buying utilities based on that theme, we think you're, 10 months too late to the trade. So now's a good time to be making some swaps, getting out of those overvalued utilities like Southern Company and Dominion Energy, two stocks that we rate with 2 stars, and look for the more undervalued ones out there like Evergy. That's a 4-star rated stock, trades at an 8% discount, and NiSource would be another one that's a 4-star rated stock, trades at a 5% discount.
How about small caps, David? They look interesting to you here?
Exactly. Small caps, when we look at them relative to the overall market, are trading at what we think are some of the lowest valuations on a relative basis that we've seen over the past decade. In fact, right now the small cap category is trading at about a 16% discount to a composite of our fair values. So I think there's a lot of opportunity in small caps. Plus, just even away from kind of that fundamental basis, small caps historically have traded very well in times when interest rates are declining and the Fed is easing. So I think we're going to have some good positive technicals there as well.
David, thanks so much. Good to see you.
All right. Well, thank you.